Good afternoon, everyone, and good morning and good evening. As this is a global webinar, there's many people joining us around the world. I want to make sure everyone feels included, and thank you all for joining us today. My name is Paul Schiavone. I'm the Regional Manager North America for Financial Lines, also for Long Tail Lines, and also for ART here at Allianz, AGCS, and North America. I will be your moderator for today's panel, COVID-19, Impacts and Opportunities in Directors and Officers Insurance. We'll cover claims trends, and underwriting during the show. And for today's program is being recorded, and you'll be able to review or share the recording subsequently. And I wanted to thank our co-sponsors today, and that is Clyde & Co. And as a representation or representative from Clyde & Co. is Kim West, who's a senior equity partner at Clyde & Co. and also a longtime friend of mine over 20 years. So I'm very happy that Kim can join us. Also joining us, Jim Ilardi. Jim Ilardi is the regional head North America for Financial Lines Claims. With him is Chris Vlasich, and Chris is an AVP and the Regional Complex Claims Manager for Financial Lines in North America. We also have Joe Caruso. Joe is our Financial Institutions Regional Manager. And Shanil Williams will also be joining us. A bit of a technical difficulty, but Shanil will be joining us during the broadcast, and he is the Global Head of Financial Lines Claims. So Allianz is looking at the issues around COVID-19 and how it impacts financial lines and directors and officers insurance on a daily basis. And we want to keep our clients, our customers, and our business partners as up to date as possible, which is why we wanted to have this webinar today around COVID-19 to make sure that we're sharing as much information as possible. And we want this to be an interactive discussion, so there will be opportunities for you to have questions, and please submit those online. And to the extent that we have time, we'll get to as many audience questions as we can. So with that being said, I just want to kick off the presentation and looking at more of a global view of how we see financial lines products just generally around the world impacted with the coronavirus and COVID-19. And really the way we look at it is it's impacting many lines of business, not just directors and officers insurance, where we're seeing securities class actions and we're seeing potential bankruptcy claims in the fall, but you're looking at agency and O claims, you're looking at potential liabilities in mergers and acquisitions. And this is all leading to potential liability. Some of it is hitting us now, and some of it is what we're expecting in the future. If you go on to the next slide and you see what we're looking at. So you're looking at directors and officers insurance, you're looking at M&A. With the M&A, it's a double impact. So not only are the potential M&A claims that could get up COVID, but also the deal flow has dropped dramatically. We're expecting that to pick up in the fall, but this is an effect, a knock-on effect of COVID-19. With E&O, you're looking at professional liability around whether that's agents, E&O, or service providers. Crime, that could be connected also with cyber. You're looking at external threat, and we'll talk about this a little bit as we move forward. But people are working from home more, and with that potentially comes cyber ransomware issues and things like that. So, these are things we need to look at, and of course, with employment practices. Now, many employees are not in the office, but that still doesn't mean that they're not employment practice obstacles that we could come across. And also, and we'll touch upon this as well, work from home. How does that impact? And also the return to work policies will also potentially have a problem. So if we go on to the following slide.
Hi, Paul. I'm here.
Oh, Shanil is here. Fantastic. Perfect timing. Shanil has joined us. So Shanil, we just started on the global. So I gave a little bit of introduction, but why don't you go ahead and give everyone an overview of what we're seeing on a global basis and in connection with the slides.
Thanks, Paul. And yes, sorry, that wasn't pre-planned entertainment that I would get locked out as we started. Yeah, so maybe we just go back to the previous slide quickly. We wanted to give sort of a high-level view, financial lines global impact, and it's very different, I think, between the lines of business. And the question I get asked a lot is, how do you think about this versus the GFC? And we think of it very differently. The GFC was a inside-out issue with bad actors, clear wrongful acts, whereas this is more an outside in. You know, and basically the tap's being turned off on business. So it's impacting things in different ways. M&A, obviously, you know, a lot of deal flow and a big premium impact for us and others. And then we expect that V-shaped bounce on the reps and warranties. And that will be interesting because, of course, there will be some distressed opportunistic plays out there. The E&O, again, we'll touch on it later, but very much dependent on profession. Construction, for example, a lot of projects are stopped. People are having to switch different labor because labor can't move. Products can't move, switching supply chain, so some things there. And then just for time on the D&O, I've linked it obviously to the M&A because there will be some M&A activity we expect Q3, Q4, and obviously 2021, and that plays into not just reps and warranties, but also D&O, and of course the cyber threat, which has become increasingly more a D&O issue. Although, you know, some of the stats we look at, including Microsoft, there was about 1 million attacks per day, COVID related in March. That's dropped to about 100,000. So there is a bit of a falling away there. So just, perhaps we go through to the next slide. So D&O, yeah, obviously as someone that looks after a global book, D&O is a, shall we say, exciting line of business at the moment. And I thought it was worthwhile, you know, looking at the pre-COVID, where the industry was challenged already by two things, obviously pricing suppression, but also a growth, particularly in the class actions side. So that, yeah, that created a challenge. And now on top of that, you have COVID, which for me, without going through each of the boxes at the bottom there, it's going to be a more broad-based impact. So, you know, a lot of the issues we've seen in the D&O market, particularly around securities class actions and in the US or in Australia and emerging in other places like Canada, whereas, you know, COVID, obviously there's a broader impact, global impact without boundaries and insolvency, which I know as a panel we'll touch on later. So yes, challenging times, and I think, yeah, it just puts on top of an already challenging market globally for D&O. So again, apologies, and thanks, Paul. Back to you.
Thank you so much, Shanil. No, it's wonderful you're here. That's the most important thing. So on to the following slide. We want to get a little claims perspective of what we're seeing. So what type of D&O claims has Allianz seen so far? Jim, I'd like you to lead off with this, and maybe Chris can make some comments.
Sure. So I can't speak about claims specifically, obviously, but what I will say is that we have seen claims involving 10b5 shareholder class actions, derivative actions. We're starting to see the SEC get more active in bringing proceedings. The claims that we've seen on the 10b5 side primarily involve cruise lines and some pharmaceutical companies, and we're also starting to see derivative litigation against boards, and we've also seen obviously a highly publicized claim involving a social media company. So there's no sacred cows here. Everybody is impacted by it. We expect that there's going to be more litigation in the coming quarters, primarily driven by the disclosures that are going to be required of public companies, particularly in connection with their COVID-19 exposures. And there's going to be more to talk about that later. And I'll pass it over to Chris because he can talk about some of the EPL and other areas in management liability.
Yeah, thanks, Jim. We thought we would also touch on a couple other areas that may, in fact, potentially lead to D&O litigation, as well as I'm sure a number of you are just curious generally. We have seen a number of EPL cases ranging from the relatively minor claims, such as employers refusing to allow accommodations for employees when they have a coworker who's been sick, refusing to allow work from home, to some of the more serious claims, such as medical staff who've been forced to work, particularly in March and April, to work at hospitals without the proper PPE, and we've seen cases where people claim that they, or their estates did, claim that they contracted COVID at work and died. We have seen some class actions on behalf of nurses claiming they did not have the appropriate PPE, although some of those have been resolved shortly. We expect to see an increase in EPL throughout quarters 3 and 4 as companies attempt to return to work. We have a section on that coming up later, but we do expect that to be a problem for companies as they try to ramp back up and get the offices going again. We've also seen a number of FI E&O matters, what we call banking E&O, based in large part on the Paycheck Protection Program, so these PPP-related lawsuits. We've seen some on misallocation of funds. For example, they claim that the PPP funds went disproportionately to larger companies. We've already seen one 10B case on that one. We've also seen a number of claims where the recipient's agent, which is typically a CPA or accounting firm, claims that they failed to receive a statutorily required fee, which is set forth in the PPP. We've actually not seen many claims by businesses claiming that the banks failed to properly distribute PPP funds, but we may see those in the future. And there's also a real concern of litigation against the PPP recipients. You may have seen a number of recipients return PPP funds shortly after receiving that. Some was due to some external pressures that were applied to them, but you've also got some concerns about following the Byzantine PPP rules and regulations. You can see lawsuits there ranging from False Claims Act cases, DOJ investigations, and possibly even securities class actions and derivative suits. The last one is consumer class actions. We've seen a number of these relating to failure to reimburse customers. So that runs the gamut from gym memberships, for example, being closed down but still charging their customers, to music and sporting events where people paid for tickets and the events were canceled and not being reimbursed. So Paul, those are just some of the things we've seen that potentially could end up relating to some future D&O claims as we move forward.
That's great, Chris. Jim, just one quick follow-up. People have noticed that securities class actions have dipped dramatically during this COVID-19 time. I know that you have an opinion on that, and people, I think, are wrongly assuming that these claims are somehow going away, but actually that's not the case, right?
Yeah, two things on that. One is, it's the old saying about tide lifts all boats, and I guess, when it goes out, it lowers. And, obviously we've seen the stock markets go down dramatically over the last several months, and now they've recovered quite a bit. And so, plaintiffs in bringing 10b-5 actions have to show a strong inference of scienter in order to support their claims beyond the motion to dismiss. And that's tough to do in that type of situation where you have the entire market going down contemporaneously. So that's one item. The other thing I would say is that there's just two other points. One, I just wanted to throw out a practical tip to the brokers. I know there's a lot of brokers on the phone, on the WebEx. So we're getting different types of claims come in the door. We're getting notice of circumstances that are very well prepared, detailed. We're also getting, typical normal, quote unquote, normal claims. And then we're getting very generalized notice of circumstances, which don't really comport with the requirements of the reporting provision under the policy. And I think it's very important to understand what we're doing when we get those is we are writing back to the brokers and saying, guys, gals, you need to give us the details. We understand you don't have all the answers, but you got to give us something to work with so that we can keep it in our house and consider it a good notice under the policy. So I think it's very important to pay attention to that from a brokerage perspective.
That's great, Jim. Yep.
Hey, Paul, can I just touch on that one just to add one thing to what Jim said? We've only seen 13 securities class actions so far, and I suspect if when the entire world shut down in March, I had told you 3 months later there will only be 13 securities class actions, you probably would be surprised at that. But I think a lot of the high-end plaintiffs' firms are waiting to see which companies bounce back and which companies don't. Right? And I think a number of these may not. So they may just be looking at it as it's too early to tell which are the good cases to jump in on and which would they be just spinning their wheels. And you're potentially going to get some sympathetic courts at this point where they're looking at the entire market goes down. Essentially, the U.S. government shut down most of the economy. They're not going to be blaming the companies for that. So we're really going to take a look in third and fourth quarter and see as things open back up and as you're getting past that bounce back period, do we actually end up seeing a number of cases then?
That's great. Kim, did you have a quick comment?
It's very much related to Chris's point. This has been characterized as event-driven litigation, and it's not just any event. This is a black swan event-driven litigation. As a consequence, the early cases are characterized by very short class periods. In fact, a class period, one of the cases only has a 1-week class period. Some of the class periods are only 1 month. The point is, the shorter the class period, the less the damage is exposure. So in these early cases, there's not going to be a big payday for the plaintiff's bar, even if they get past the motion to dismiss phase.
That's a very good comment. Thank you, Kim. On to the next slide. The following slide, I want to focus a little bit more on underwriting and get Joe and Shanil back involved. So Joe, why don't we start off with you, and Shanil, please comment. So what do underwriters need to do better to understand the exposures right now with the coronavirus and post-coronavirus and going into the fall? What are underwriters doing differently? And are there new strategies for certain industries? Joe?
Yes, Paul, thanks. Given the uncertainty in the financial markets and the long-term economic impact of this pandemic that we're, confronted with, the market volatility has not diminished for the companies that are directly impacted. Industries like airlines, hospitality, travel, restaurants, the larger restaurants really, retail will continue. They have been impacted and will continue to be negatively impacted as we continue to work our way through this pandemic. As underwriters, we need to address these new exposures in our underwriting analysis so we can get a better understanding of what these companies are going to look like as they come out of the pandemic and what the ultimate impact might be. So we've derived some questions. Some are general in nature. They're more public D&O related, commercial type industry related questions. And then specifically, we've created some questions for financial institutions that are more segmented. So I'm going to take you through what you can expect today when you're dealing with an Allianz underwriter, some of the questions that your customers and clients should be hearing and being queried on by our underwriters. We ask questions relating to the board. We'll ask, has meeting frequency changed? Have any special committees been formed specifically relating to COVID-19? Are they utilizing, external resources for advice on decisions relating to COVID-19? Do they have continuity plans in case the executive or C-suite might get impacted as a result of COVID-19? We ask questions relating to specific company risk management. Are there changes to travel policy? Obviously there are and have been and continue to be. We ask questions relating to, compliance with employee obligations under employment laws and under HIPAA type, requirements. So you'll see underwriters asking questions specifically around that. When it comes to financing and liquidity, some of the financial questions, our underwriters would be asking companies whether or not they're planning to add or take on debt during this period of time to address liquidity concerns. Are they planning to potentially reduce their operations during this period of time? Has that been vetted by a third party or legal advisor to make those decisions? Are there potential changes to dividends or share buyback or cash flow management? Those are important questions that we're going to seek to get answers on. Disclosure issues relating to the SEC or supply chain. We'll ask questions. Have they made any 8K disclosures, or is there going to be any changes to guidance that they're putting out to their shareholders or stockholders? Supply chain. Has there been any change to the disclosure impact relating to supply or customer impact, and has that changed from previous disclosures that they might have put out there? Does the supply or customer impact create a bankruptcy risk for the potential organization, or do they anticipate any impact to contractual obligations? So cybersecurity and privacy, that's another area, given the new environment that we're all operating in under the work from home, remote environment, are companies taking measures to mitigate risks of security breaches? And if so, what are they doing? Explain some of those, take us through it. As I said earlier on, we have some specific questions that we've created and addressed for financial institutions, because they're likely to get impacted as a result of what's going on under the current market environment and under the COVID environment. For banks, we're obviously, heavily concerned about, credit and loan defaults. We ask our insureds, what exposure does the bank have? The impacted industries that I discussed before, do they have large concentrations in CRE, commercial real estate? What are potential sources of liquidity? That, are they accessing the Fed window? Things like that are important to us. Are they anticipating goodwill impairments? Have they made pandemics part of their living will and stress testing for some of the larger global financial institutions? Insurance companies, we look at their investment portfolios, whether or not they have exposure to some of the impacted industries, oil and gas, hospitality, travel, leisure, airlines, etc. Have they sold investments during this market sell-off time, during the downturn, at a loss? That's important for us to know. Life insurance companies, any recalibration as a result of the historically low interest rate environment that we're operating in? What types of products they're selling? Are they likely to be impacted? Any modifications going on? Do they plan to have budget adjustments? Were all the tax, implications reviewed or assessed? The last two segments I'll talk about is just quickly is asset management, and those are a little different than the ones I just mentioned. But for asset managers, we're concerned whether or not they might have any impact to, involvement with their service providers, like their prime brokers and their administrators. What's their steps around communication for their investors, for their clients, their LP base? Are they experiencing significant, redemption activities? How will they be able to meet those obligations for redemptions? Do the governing documents that they have outline sort of different options around redemptions? Will they use gates to help slow the redemption process? We look at their investment mix. Again, if they have a significant exposure to the impacted areas, do they use side letters with their investors, and whether or not they're reviewing their notice requirements and complying with them under those side letters? Are there plans to make valuation adjustments, fund share valuation adjustments? And are they using third parties to help them make those adjustments and valuations? And the last in the asset management space would be, are they going to add pandemic risk-related factors to their offering documents? The last thing I'll touch on is just private equity, and private equity is a little different, and the exposure there, obviously, as you all know, really falls into the portfolio, assets that they have in their investments. And we look at the portfolio company investment mix by industry. We look at potentially what portfolio companies might provide services to affected industries. We look specifically at any operations for some of the portfolio companies that might be impacted by the pandemic. Have any of them failed to make debt payments, or any on the verge of bankruptcy? Do the PE firms themselves help out with the portfolio companies to help ensure supply chain operations to keep it going? Are there contingency plans identified? We look at all these different communications with their lending partners at the portfolio company level. What solvency issues might be out there for their LPs? Is there any potential pullback by investors as a result of COVID-19? So these are a lot of the types of questions that you as brokers and clients, you should be hearing and hearing from my underwriters as they're going through an analysis, whether on new business or renewal for Allianz. Paul, back to you, or Shanil, you might have something.
So, Shanil, any comments on any
We lost Shanil again.
Okay, we'll come back to Shanil. So listen, let's go on to the next question, to the following slide, which is on disclosures. So Kim, why don't you take this one? So what should companies be doing? Which disclosures should companies be making following SEC comments on coronavirus?
Okay, I think we have two separate categories here. First, we have the disclosures to mitigate against the securities class actions. And then we have corporate governance responsibilities and board duties to mitigate against shareholder derivative actions. So with respect to the securities class actions, I mentioned earlier that the first wave of lawsuits was attributable to a black swan event and characterized by short class periods. The second wave of lawsuits are going to be lawsuits arising out of stock drops based on alleged misrepresentations and omissions with respect to how the COVID pandemic impacted the company's revenues and business operations. So it's the second wave, it's no longer a black swan event. And these lawsuits are going to be characterized by longer class periods and frankly, higher damages exposures. But the disclosures and the risk can be managed. My first point, and I think some of the pharma cases have been, and medical cases have been filed are a good example. Beware of puffery and making overly optimistic statements. Don't make overly exuberant statements about your capabilities. That would be one. Second, and I think this is relevant to the cruise lines, be candid about the potential impact of the COVID pandemic on your business operations and revenues. Don't mask the problem. Third, it's important to accurately and completely convey the material risks posed by the COVID-19 pandemic on your particular business environment. You've got the MDA sections of your statements, risk factors. You can discuss it in the context of known risk, trends, and uncertainties. But it's important to be specific to the sector and markets that you service as a business. Earlier mentioned, Joe mentioned supply chains, distribution channels are important. Your markets are important. For example, one of the recent lawsuits pertains to a real estate investment trust. Obviously, the real estate market's a different market. It's the risk factors in that segment are going to be different than other sectors. Next, be very careful about guidance. I would say either to consider amending guidance, withdrawing guidance, or doing what a lot of companies are doing now, not providing any guidance at all. So in general, more fulsome risk disclosures, less guidance. And last, you could reduce the scienter component or element of a 10b5 class action by reviewing your trading policies, particularly your 10b5-1 plan, trading plans, and also how you treat options. So those are things that can be done to mitigate against 10b5 risk. Turning to the shareholder derivative actions, which is really fundamentally a corporate governance issues, the boards and management must truly understand and discuss the pandemic risk. And you have to be able to document that and show that you've considered it. And if necessary, use committees and experts to assist you in your analysis. Don't ignore red flags or yellow flags. This isn't going to go away. You have to deal with it. And if you ignore it, you will probably just increase the exposure of a Caremark claim for lack of oversight. It's critical to make informed business decisions with the input of experts and consultants. You've got to deal with regulatory issues. Some sectors are regulated more than others. And I find the heavily regulated industries have more exposure to secure shareholder derivative actions because they're subject to fines and penalties by the regulators that can be part of the damage to the corporation, which is essential to a shareholder derivative action. You've got the health and safety issues to contend with. And as Joe mentioned, it's important to monitor your liquidity and also perform stress testing. It's particularly critical in light of certain restrictions under Delaware law, for example, on when you can issue dividends or make stock repurchases. Your liquidity is critical to making those types of determinations. And last but not least, it's really important more than ever to document what the work you're doing. And in particular, don't overlook your board minutes. It's very important you have thorough board minutes so that if there is a securities class action or 220 demand at some point, I'm sorry, if a shareholder derivative action or 220 demand, you can show through documentation and proof that you haven't ignored or breached your oversight duties. You've done everything you possibly could. You gave careful consideration to the risk, and you assessed the risk as best you could, and you made informed, educated business judgments.
Tim, that's great.
Hey, Paul, I'm back if you could hear me.
Oh, and perfect timing, Shanil. Excellent, excellent. On to the following
I'm
slide.
keeping you on your toes here as a moderator.
Absolutely. So the next slide I want to talk about is return to work. And I'd like to focus this going back to the claims department, starting off with Christopher. So how does Allianz view return to work policies as potential liabilities for companies and Ds and Os? Chris, if you can lead that off.
Yeah, Paul. Well, I mean, it's such a problem that we actually recommend companies conferring with Employment Practices Council relating to establishing reasonable protocols for returning to work and establishing steps taken to ensure the safety of their employees. You might want to play around on the EEOC website if you have questions on this. They have a comprehensive page of frequently asked questions broken down into different segments, such as ADA compliance, confidential medical information, reasonable accommodation, etc. You can spend hours going through it. I mean, here's the problem for the employers, right? We have a number of factors that we know lead to increased risk of if you get COVID-19 of having a negative outcome. Many of those questions that the employers would ask, they can't ask because of ADA issues and other reasons. And we all know that if somebody gets it in the office, there's a potential spread to other people in the office. So arguably, some of these restrictions are placing employees in greater danger of exposure. So employers may want to use carefully crafted surveys to collect information from their employee population on their willingness to return to work and what the employers can do to make employees feel safe. Let's talk about some of the key factors here. Those that are 65 and older, pregnant employees, or those employees who have family members with COVID. An employer cannot exclude a 65 and older employee from the workplace, even if it is to protect them, because it violates the ADA. The employers are required to provide reasonable accommodations to pregnant workers under the Pregnancy Discrimination Act. And there's no legal requirement to provide accommodations to employees with family members that are higher risk, but that's at the employee's option. Employers should provide accommodations for employees who need that for disability reasons or for religious reasons, and also possibly for employees with childcare or elder care responsibilities. The EEOC has drawn a distinction between COVID antibody tests and COVID, the active test for if somebody has the virus at this point. Antibody testing has been deemed to be a medical examination under the ADA, and employers cannot administer such tests. But they are able to administer tests to determine if someone's actively infected with COVID-19 now. So you can see all the different concerns that you've got with these employees returning to work, particularly at this point when we're still learning more and more each day about COVID, about exposure, about how it's transferred, and some of these risk factors. Then the employers have to take this in light of the additional work from home issues, and we'll talk a little bit later about the more employees you have working from home, you're potentially increasing the cyber risk and potentially D&O claim, versus especially in Chicago, New York, and some of the larger areas where you're effectively requiring your employees to return to work, and then they'll be taking mass transit, and there's potential issues there. Finally, we've got the second wave issues, and I believe we all heard Dr. Fauci this week talking about we're not even talking about second wave because we're not done with the first wave. What happens in October, November if we're all back in the office and then we have subsequent waves of COVID exposure and companies have to shut down again? Just keeping in mind the plaintiffs' counsel, when they're filing the security suit, will have 20/20 hindsight of, well, you never should have brought people back in, you brought them too quickly, should have allowed additional work from home. A number of issues that these employers are going to have to focus on. But Paul, I think the number one is to have a plan and work with counsel to make sure that you are following all of the various federal and state laws.
That's great, Chris. That's wonderful. All right, let's move on. Let's get back to underwriting. So we're going to move on to the following slide, talking about exclusions. So, and Shanil, let's lead off on the international side. So what has the industry's position been with COVID exclusions, and what should insureds expect down the road with the economic downturn? Maybe start with Shanil and Joe, comments about the U.S.
Yeah, sure, Paul, no problem. I mean, we haven't seen a blanket approach to exclusions, and I think we as an industry, we need to be careful here. I mean, this is a moment of truth for directors, and for example, when we've been thinking about this, which of course we have been. If you're applying a very broad-brushed exclusion, anything related to COVID, then what are you excluding? If the board is working from home because of COVID, is there no cover? I mean, you really need to think through what are the issues that perhaps are not underwritable or deserve that. I mean, our approach is no blanket approach. Also, just to link back quickly before I dropped off with Joe, I mean, our underwriters are treating each risk individually, whether that's the questions they ask or the exclusions they apply. So we don't see it broadly. We've seen some more specific ones. And we tend to, I want to bring it back to underwriting 101, is if you see a solvency issue with that particular industry due to social distancing, then, think about an insolvency exclusion. So at the moment, no broad brush approach. We're going to keep doing that. We're going to keep underwriting, listening to our insureds, having those conversations, and not have a brush approach. But let's see. At the end of the day, we also have to look at the risk return and see how it plays out, particularly if we get to, Chris said, wave 2 or even wave 3.
Thank you, Shanil. Joseph?
Yeah, so very similar in North America to the comments that Shanil made. We're not seeing exclusionary language specific to COVID-19 being placed on insured policies in financial lines for public D&O. Where we do see some exclusionary language for bankruptcy or insolvency is more private company segment. And we've seen some of that, but not a broad brush approach. We are not slapping on a COVID-19 exclusion on our insureds. We assess the potential impact, asking the questions that I went through earlier, and then based on our underwriting analysis, we will, based on the answers that we received, to the best that we can assess it, we will make some decisions around premium, capacity, higher attachments, higher SIRs, or potentially, if we're uncomfortable with the risk, we may either walk away or maybe not write it if it's new business. But yeah, so we're underwriting to each risk based on the merits that they bring to the table, and to the best that we can underwrite the unknown COVID, we put that into our process.
That's great, Joseph. And none of us really know what's going to happen with the economic downturn come the fall. So this is all up in the air, but we keep our eyes on it. It's a very good message, and it's a fair message. So let's go on to the following slide, and I want to direct this one for Kim, and also if Jim would like to make a comment on fiduciary duty, derivative litigation. Kim, you touched upon derivative litigation a little bit before. What fiduciary duty concerns and derivative litigation concerns should companies be aware of?
Okay. I think the primary concern has to be the Caremark claim for breach of the duty of oversight, and based on having an adequate system of internal controls and procedures. I think it's important to remember a shareholder derivative action is brought by a shareholder for damage to the corporation, not for individual harm. So you have to show some type of damage to the corporation. And in many cases, that can consist of loss of business and revenues in general, or regulated industries are susceptible to shareholder derivative actions because there's always the potential for significant regulatory fines and penalties, which are considered damage to the corporation. And then also in the context of the regulatory environment, you have regulatory investigations, which lead to investigation costs, which also can be considered a component of damage for shareholder derivative action. I think one of the primary risks, and Chris certainly touched on it, is the return to work situation. I think that's an area where there is the most significant potential exposure for a Caremark type claim. I want to imagine this scenario. Some type of company has its employees return to work. Okay, a number of those employees die from COVID-19. They claim they contracted it in the workplace. As a result of that, the facilities had to shut down. There were employee layoffs. All of this led to a liquidity crisis. That's the kind of situation that's potentially out there. Well, what I just described is an actual shareholder derivative action. It's Marchand versus Barnhill, which is a June 2019 case involving a listeria outbreak which struck Bluebell Creameries. 3 employees died. There was a recall of all the products. There was a shutdown of the facilities, employee layoffs, all of which led to a liquidity crisis. And that, as a result of that, the shareholder derivative lawsuit was filed, which alleged that management and the board had failed to respond appropriately to red and yellow flags about the growing food safety issues. And Caremark claims were asserted because based on the allegation, the management and the board failed to implement an adequate reporting system and failing to be informed about food safety compliance issues. It went to the Delaware Supreme Court, and the Delaware Supreme Court found that the plaintiffs had sufficiently alleged that the board had made no effort to establish a board-level system of monitoring and reporting, and that there was really an absence of any showing, at least at the pleading stage, of a good faith effort to fulfill their responsibilities. A little earlier, I touched on what you can do to mitigate the risk, but in this particular case, there's no indication there were ever any committees were formed. There were no regular processes or protocols. There was no regular schedule to discuss food safety issues. There's no indication of any concern about these issues in the board minutes. And the company said, well, but we had to comply with the FDA. And of course, the court said, no, FDA compliance is not sufficient. You have to do a lot more than that. So I think return to work is probably the area most fraught with peril in terms of potential shareholder derivative actions.
That's great, Ken. Thank you so much. Listen, I'm very conscious of time, so I want to get to the next questions. I think we've had some audience questions come in which are similar. So if we go on to the following slide, and this is more for a panel discussion, but I will lead off with Joe and underwriting, but Jim and Chris and Kim, I'd like to hear from all of you. And it's around bankruptcy. So one, will we see bankruptcies in the fall? And I think many of us will already say, yes, we will, looking at the economic situations. Which industries will be affected? What will underwriters do around these bankruptcies? And which stakeholders are likely to bring lawsuits for insolvency or bankruptcy? Joe, maybe a high-level view on the underwriting's perspective of those questions, and we'll go over to Shanil.
Sure, thanks, Paul. Look, there's no doubt, based on the economic downturn and the market volatility, that we'll eventually in the third and fourth quarter here probably see an uptick in bankruptcies. And a lot of the bankruptcies are probably going to fall within the industries that we identified before. Not to get into all those again, but you're likely going to see bankruptcies, in those segments that are probably, for the larger companies, a lot of them are probably going to be orderly, prepackaged type bankruptcies in nature, where they have a path, basically to kind of reduce their debt loads and have like a reemergence plan to come out of it. So more along the lines of the Chapter 11 type, bankruptcies. I think, that's a big assumption that COVID-19 doesn't get worse in the current environment that we're operating in. So I think, look, we've seen since March, the S&P, and these are credit ratings, but still, it's important. They've taken 370 credit actions since March, downgrades. So, as those start to continually be evaluated and looked at in relationship to the impact and the financials, they could lead to further downgrades and then ultimately, to a path towards bankruptcy. So I do think we're going to see it. I do think some of these companies, though, smaller ones, like I was reading something today. restaurants, the smaller, the fast food guys that have been operating during this pandemic seem to be doing better. It's the larger restaurants that have been largely shut down that are going to get impacted. You know, retail is obviously a concern. You're seeing a lot of action by a lot of the large retail companies. You know, obviously the hospitality, the travel and leisure, and some of the things that Kim talked. I think you're going to see, you know, potential bankruptcies in those segments. And as underwriters, what we're going to do, a lot along the lines of what I discussed earlier, is we're going to have to continue to have more detailed underwriting analysis regarding the specific impact, underwriting what's causing the problems. Is there a path to emerge? You know, you're going to see continued rate on pressure, continued pressure on rate and premiums going forward in the market that we're operating in, that was in existence pre-COVID. That only now has been exacerbated by the impact of COVID-19. You know, you might see potential reduced capacity available. You might see higher retentions or SIRs. You know, you might see the use of co-insurance as a you know, mechanism to get more skin in the game from clients and so forth. So those are types of things I think as an underwriter we'd be doing.
Okay. Shanil?
Go ahead.
Sorry, Jim.
Yeah, just very quickly for time. I mean, there's a couple of things at play here. One is obviously when social distancing will end and those industries that are heavily impacted, as Joe said, come back. I mean, the other dynamic we have politically and through the Reserve Bank is there's still a lot of money being pumped up supporting these companies through wage schemes. And the question also is, you know, how long will that go? At the moment, you can see there's a massive divergence in stock market direction versus economic direction. And a lot of that is based on the fact that governments at the moment seem prepared to keep supporting the private sector and do what it takes to make sure there's not broad-based bankruptcies. And then, of course, by different countries, you've seen different countries put some protections in for bankruptcies during this period, given it is a black swan type event, as Kim said earlier. So, yeah, different on geography, but I think, again, certainly different to GFC and how it plays out and how the government and Fed support is very broad-based this time.
That's a good point, Shanil. Jim?
Couple of quick factoids. So the economic literature is reporting that as of right now, and we haven't even started the party yet, right? The bankruptcy filings are up 20% over the same period last year. The person who created the Z-score, which is an economic modeling method to determine predicting business failures, commented that this year will easily, quote, easily set a record for so-called mega bankruptcies, filings by companies of $1 billion or more in debt. And he expects that the number of just large bankruptcies, which are 100 million or more, will challenge the levels that we saw in the 2008 crisis. So that all said, you know, it kind of leads into, I mean, you know, we all know the names: Hertz, JCPenney, you know, J. Crew. It goes on and on. Number of oil companies. This creates a huge implication for Side A D&O, which at one time was a very sleepy insurance product with not much volatility associated with it. But I think that now we're going to see that product step up front and center with all these impending bankruptcies.
That's a great
Jim,
point.
I was just going to mention,
sure,
you know, on the Side A front, we are in the marketplace right now that we're operating in. We're starting to see a change to the pricing for Side A in the current environment. So yes, it's already impacting based on what you mentioned.
And I wanted, Jim, that was a great point. And to follow up on that, shareholder derivative actions also present a Side A exposure. So you've got the Side A exposure in the context of shareholder derivative actions and the bankruptcy context.
That's a very good point. I can see in the future, in the fall, and the renewals coming up, higher capacity. At least the customers will want higher capacity. Whether the market has more capacity for the A side, Jim, to your point, I think the market has realized it is not just an insurance where you don't ever get claims. Now you're going to start getting claims. So pricing will change, capacity will change in the A side. I think that was excellent. Okay, so we follow on to the next question. And here we're going to speak a little bit more on cyber. And I definitely would like Chris's opinion on this. So given the security vulnerabilities due to increased remote working, what are the consequences of this beyond COVID-19 on D&O, but mostly cyber claims, Chris?
Yeah, thanks, Paul. So one of the things that we have been discussing is, how does the cyber risk change when you have 10% of your workforce working from home 1 day a week, and now you have 50 to 60% of your workforce working from home 2 or 3 days a week, and all of a sudden the company says, this has actually worked out pretty well. We might be able to get rid of a floor or two downtown. We might be able to close one of the smaller offices, a satellite office, have those people just work from home. All of a sudden, your cyber risk is changing irrespective of COVID. That even once COVID, so we find a vaccine or some way to treat it, the companies might say, look, this is a much better long-term solution for us. And all of a sudden, now you have a significant portion of your workforce working from home long-term. Are the companies paying attention to that risk and doing what it takes to invest in keeping that cyber risk at bay? We're going to see increase in ransomware, potential additional cyber-related exposure that, if sufficient enough, bleeds into the D&O realm.
No, that's excellent. Chris, thank you very much. And, this topic is very important at this moment. We've recently hired Tom Tang as the new regional North American head of cyber. And there was many questions that received from the audience around cyber, around COVID, but just cyber in general. So we have decided within the next few months that we'll have a webinar solely devoted to cyber. But we wanted to touch upon it here. We thought that would be very, very important. We actually have a few extra minutes. So I wanted to get some questions from the audience. And if we can get some quick questions, we might be able to get these 2 questions in. And the first question, Jim, I'd like to open up with you. How will agents D&O be impacted during the coronavirus and COVID-19 epidemic?
Yeah, so using round numbers, I would say we probably are seeing about 30 to 40% of the claims that have come in the door, at least in North America, relating to agents and brokers E&O. And you won't be surprised by the fact that most of those arise from coverage denials by commercial property insurers in connection with business interruption claims that the underlying customers have made against their commercial property policies, which have been denied for a variety of reasons. And so insurance agents and brokers are now being, viewed as an alternative source of recovery, and so we're starting to see a fairly significant amount of claims against those individuals. The other loss driver with respect to agents and brokers E&O has to do with event cancellation. We see a fair amount of event cancellation claims coming in the door, not just through the financial lines area, but also through the entertainment division. And they have a lot of activity in that area as well. And then, of course, we have the insurance company professional liability claims, where we have policyholders suing our insured insurance companies for bad faith denial of claims. And again, all of those essentially are coming out of business interruption claims.
Right. And Jim, this is not uncommon. When insureds go to their carriers, they get denied claims or this business. Going after the agents is a fairly common practice. Is that true?
Yeah, it's a fairly common practice, and the law in terms of the standard is very disparate throughout the country. Some states recognize that there is a heightened duty on the part of the agent to their customer to go beyond just the procurement of the insurance policy. Some states are in the middle, and some states don't believe that the law states that there is no duty to do anything except what the customer asks you to do explicitly. So the law is all over the map, and it's going to trigger a lot of defense obligations and in some cases indemnification obligations.
Yeah, that duty of care question is the key. But as you said, even if you don't have the duty of care, it's going to cost you defense costs just to defend these cases and win in court. So in the end, it does cost quite a bit of money. We have time for one more quick question, underwriting question. So Joe, I'm going to leave this with you. And it's, you can do it in a couple of minutes. How would the COVID impact the existing hard market, rate increases, retentions, and capacity deployed? Maybe just give your 1 minute summary of where you think we are. Maybe Shanil can chime in.
Paul, could you repeat that? You were kind of breaking up. I'm sorry.
How will the COVID impact hard markets, rate increases, retentions, and capacity deployed? So how would this impact the existing market?
Well, we touched upon that a little earlier. I mean, I think, given where the market is right now, again, pre-COVID, we were obviously moving into a hardened market for financial lines. I think, as we roll forward and we start to kind of assess what the ultimate, impact is, Jim alluded to the fact that the game hasn't really started yet. We will ultimately have to see, what the ultimate outcome might be as a result of this financial impact and market volatility. And we'll have to make decisions around, the capacity that we deploy, whether there'll be reductions in capacity, whether or not we will, have certain coverage restrictions that we might look to deploy. Again, Shanil and I touched on this. Right now, that's not a broad brush. I think we'll assess it. We try and do our best to make certain that we underwrite each risk based on their own merits. But at some point in time, we'll have to see just what the overall impact is and what that might be. Pricing is going to continue to harden, in my eyes. I think, with the unknown exposure right now that we have, even with all the questions that I went through before and some of the underwriting analysis that we're doing, there still remains an unknown that we have to somehow try to price into our model when we're arriving at a price for a risk. And, you have to build in some cushion for the potential unknown. And that's something that we're trying to, do our best to assess and come up with the right price.
So Shanil, 30 seconds.
I don't know if he's there.
Oh, he might be on first again. Okay. So thank you, guys. I think the panel has given us very, very much to think about. There's a lot of information. I want to thank the panelists for joining. I would like to thank all of you for joining today, and I hope this was informative. And we have a lot of information, some of which you can get on our websites regarding the impact of the coronavirus and on D&O litigation, the trends in litigation, also cyber and the other financial lines products that we have. And the resources are available for you to download whenever you want. There are better times ahead. That we can all guarantee each other. And I want to thank you all again for joining. I hope you found this session very informative and helpful. And please stay hopeful. Please also, where we were sending out a survey, and it's very important for us, if you can fill that survey out, take the time, because from that survey will help us develop better webinars, better ideas to present even a better webinar than this one in the future. So please take the time, and we're very interested in your feedback and your comments. It'd be very helpful. So please feel free to share the playback of this. I want to thank you all again, and everyone be well and safe. Have a great day.
Bye.